FAR.F4.M1.
So, Jenna, I think liabilities sound way more intimidating than they really are. Every chapter seems to throw out accounts payable, accrued liabilities, payroll taxes, vacation pay, asset retirement obligations. It feels like a giant list of unrelated stuff.
That's exactly why this module exists, Russell. They're not unrelated at all. Becker is really teaching one big idea. Every topic in this module is another example of the same question. Do we owe someone something because of a past event? If the answer is yes, we're probably looking at a liability.
So, instead of memorizing 10 different accounts, I should start by asking, did something already happen that created an obligation?
Exactly. Think of liabilities as promises the company has already made, whether intentionally or automatically. Some promises come from buying inventory. Some come from borrowing money. Some come simply because time has passed and employees have earned wages. Some even come from laws that require you to clean something up years from now. Different situations. Same foundation.
I like thinking of liabilities as IOUs that have already been earned by somebody else.
That's actually a pretty good analogy. The only place it starts to break down is that sometimes nobody has sent you a bill yet. The company can still owe money even when nobody has asked for it. That's where accrued liabilities come in.
So accounts payable is someone saying, here's your invoice. Accrued liabilities are more like the company saying, nobody's billed us yet, but we know we owe it.
Perfect distinction. That difference shows up constantly on the FAR exam.
Let's start with accounts payable then.
Trade accounts payable are created when goods or services are purchased on credit. No formal note. No written borrowing agreement. Just an ordinary purchase. The amount is usually easy to determine because the invoice tells you exactly what you owe.
And Becker talks about gross and net methods for purchase discounts. Do I need to become obsessed with those?
Understand the concept more than the mechanics. Under the gross method, you initially record the full purchase price. If you later earn a discount by paying early, you recognize it then. Under the net method, you assume you'll take the discount from the beginning. If you don't earn it because you pay late, you essentially lose that benefit. For listening purposes, the important takeaway is simply that both methods arrive at the same final economics. They're just different timing approaches.
Now suppose instead of buying inventory on credit, I actually sign a written promise to repay. Different story.
Yes. Now you've moved from accounts payable into notes payable. A note is more formal. It often carries a stated interest rate. It specifies exactly when payment is due.
And then interest starts causing trouble.
Only if you forget one important idea. Interest doesn't magically wait until cash is paid. Interest expense grows with time. So if the year ends before interest is paid, you still owe interest. That unpaid amount becomes interest payable.
So here's another mental model. Cash and expense are not married. Just because cash hasn't moved doesn't mean the expense hasn't happened.
Exactly. That's probably the biggest accounting mindset students have to develop. Accounting follows economic events, not cash movement.
Which leads us straight into accrued liabilities. These seem to be the king of adjusting entries.
That's a great way to think about them. Accrued liabilities exist because time keeps moving even when cash doesn't. Employees work, utilities are consumed, rent accumulates, interest builds. The expense has happened. The payment hasn't, so the liability fills that gap.
Almost like accounting pauses the movie on December 31st and asks, if the world stopped today, what do we already owe?
That's an excellent analogy. Every adjusting entry is really answering that exact question.
Payroll always feels messy because there are so many moving pieces.
Let's organize it. There are really two buckets. First, amounts withheld from employees. Second, taxes the employer owes because it employs people.
Those sound similar?
But they're completely different economically. Employee withholdings like federal income tax withholding, Social Security withholding, and Medicare withholding belong to the employee. The company is simply collecting them temporarily before sending them to the government. They're liabilities. They are not payroll expense.
So the company is acting almost like a middleman.
Exactly. Now compare that with the employer's own payroll taxes. Those are an actual cost of employing workers. Those create payroll tax expense. That's one of the most common distinctions Becker emphasizes.
I can already imagine an exam question trying to trick someone into treating employee withholding as employer expense.
That's exactly the trap. Always ask, whose money is this? If it's the employee's money being temporarily held, it's a payable. If it's the employer's obligation created by employing workers, it's an expense.
I love that question. Whose money is it? Simple.
Simple questions often solve difficult accounting problems.
Now, let's talk vacation pay. This one surprised me because you don't always record it.
Correct. Becker gives 4 conditions. Vacation is accrued only when those conditions are met. Employees have already earned it. The rights vest or accumulate. Payment is probable. The amount can be reasonably estimated.
So, we're asking whether employees have already earned future paid time off.
Exactly. The company isn't recording vacation because people might someday take time off. It's recognizing an obligation that employees have already earned through past service.
Again, the past event creates the liability. Everything keeps coming back to that.
You're seeing the pattern. That's what makes this chapter much easier.
What about self-insurance? That seemed strange at first.
Think about what self-insurance actually means. Instead of paying an insurance company to assume the risk, the company keeps the risk itself. If claims become probable and reasonably estimable, the company records a liability for expected losses.
So, choosing not to buy insurance doesn't mean choosing not to recognize liabilities.
Exactly. Economic obligations don't disappear just because you didn't buy a policy.
Then Becker shifts gears into exit and disposal activities. At first, I wondered why this belonged in the same chapter.
Because it's still about liability recognition. Suppose management announces they're closing a factory. Does that announcement alone automatically create a liability? No. The key question is whether a present obligation has actually been created.
So, management simply talking about something isn't enough.
Right. Plans alone aren't liabilities. The liability arises only when the criteria for recognition have been met. The company must have committed itself in a way that creates a present obligation.
That's another good exam mindset. Intentions are not liabilities. Present obligations are.
Exactly. Intentions are free. Obligations cost money.
I like that.
One thing Becker also points out is that these costs aren't just any future expenses. They specifically relate to exit or disposal activities like involuntary employee termination benefits or certain contract termination costs.
Now we reach what might be the strangest topic in the module: asset retirement obligations.
Students often think these are weird. Really, they're just another application of the same liability definition. Imagine you build an offshore drilling platform. Years later, you're legally required to dismantle it. That cleanup obligation didn't suddenly appear at the end. It existed the moment you created the asset that carried the legal obligation.
So the liability is born alongside the asset.
Exactly. That's why Becker records 2 things immediately: a liability called the asset retirement obligation, and an asset called the asset retirement cost that's added to the long-lived asset.
That always seemed backwards to me. Why would creating a liability also increase an asset?
Think of buying a house that legally requires expensive demolition someday. The total cost of owning that house isn't just today's purchase price. Part of today's acquisition includes that unavoidable future cleanup. Capitalizing the retirement cost recognizes that reality.
That analogy actually makes a lot of sense. The future cleanup is part of what it costs to own the asset.
Exactly. Now comes Becker's first passkey. The liability is initially recorded at a discounted amount. Over time, it grows through accretion expense until it reaches the amount that will eventually be paid.
Accretion always sounded mysterious. Really, it's just interest caused by the passage of time.
That's a great way to remember it. The liability slowly grows because we're moving from present value toward future settlement value.
Meanwhile, the asset is doing something completely different.
Right. The asset retirement cost is depreciated just like the rest of the long-lived asset. So one side grows through accretion. The other side shrinks through depreciation.
That's actually elegant. One account walks upward, the other walks downward.
Exactly. And Becker's second pass key ties everything together. By the end, cumulative accretion expense plus cumulative depreciation equals the original asset retirement obligation. That's the relationship they really want you to understand.
I wouldn't memorize that just as a formula. I'd picture two people climbing opposite sides of a hill until everything reconciles.
That's actually a useful mental image. Just remember which account is doing what. The liability grows. The capitalized asset gets depreciated. Don't reverse them.
Let's zoom out before we finish. If someone asked what this entire module is trying to teach, I'd say it's really teaching different ways obligations arise.
That's exactly the big picture. Buying inventory creates accounts payable. Signing formal debt creates notes payable. Time creates accrued liabilities. Payroll creates tax obligations. Employee service creates vacation liabilities. Exit decisions can create disposal obligations. Owning certain long-lived assets creates retirement obligations. Different events. Same accounting definition.
And nearly every exam question starts with the same detective question. What happened in the past that creates an obligation today?
That's the question to keep asking. Not when cash moves. Not when the invoice arrives. Not when management finally gets around to paying. Ask what event already happened. Once you identify that event, the liability usually becomes much easier to recognize.
My biggest takeaway is that liabilities aren't a collection of random accounts. They're one idea wearing different clothes.
Exactly. If you leave this module remembering only one thing, remember that liabilities are present obligations created by past events. Everything else in this chapter is simply another illustration of that principle. Once that mental model becomes automatic, the journal entries become much easier to understand instead of something you simply memorize.